Are you interested in learning about investing but don't know where to start? Tired of working hard for your money but feeling like your money doesn't work hard for you? Well, welcome to the Apogee Wealth Podcast. I'm your host, Jonathan Nichols. Each week on this podcast, we break down the mindset, principles, and strategies that you can use to grow your wealth and live the life that you feel you were called to live. I hope you get a tremendous amount of benefit from this episode. Thanks for tuning in. So a quick overview of some of the things we're going to talk about. Again, this is not going to be a super extended presentation. I'm not here to bore you to death, but just want to give you some of the highlights about multifamily investing for those of you that maybe are not as familiar with it. So, what is multifamily investing? Why would we want to invest in multifamily? Who are the people associated with multifamily deals, or what are the key roles in a multifamily project? And then if you're interested, how can you get in started as an investor? So, what is a multifamily syndication? So, syndication is a group investment model, which means you have investors who pool funds together in order to buy large commercial apartment assets. There are two types of partners within a syndication project, and we'll be talking quite a bit about both of these this evening. The first one are the general partners, and you can think of this as basically like the sweat equity of the deal. And then there's also the limited partners, which invest passively and are, of course, the capital in the deal. Now, most of the deals that we're talking about within the context of multifamily syndication are 50 plus units. I would actually say typically 100 plus units, and usually more than five. Once again, probably more than $10 million in value for our average acquisitions. So we're talking about very large real estate investments. And we'll talk in a minute about why we like these types of investments. But generally, when we talk about multifamily syndication, we're talking about a group investment model that consists of general partners doing the active work on a deal, as well as limited partners who are placing their capital in a deal. So, why would we want to invest in multifamily? If you're here on this call, you probably recognize that real estate has long been a great investment opportunity for those that know how to approach it correctly. Many of the wealthiest people in America have invested in real estate and made their wealth through real estate. But perhaps you're wondering, why would I go into an apartment complex or a large commercial asset as opposed to just buying, say, a single family rental? Well, when we talk about multifamily, and particularly for the purpose of this presentation, we're talking about properties that consist of five or more units within the building. And the reason or the distinction of why we talk about five or more units is this is the distinction that divides commercial assets from residential assets. And so when you talk about purchasing a residential home or building, so that could be a single family home, a duplex, a triplex, or even a quadplex, the value of those buildings is based on comparable sales. So you've probably come across this if you own your own home, if you live in your own home and have been through the house purchase journey. And you know that a part of what your real estate agent will do is go out and pull comps or comparable sales in the area that kind of give you an idea of what's a fair price for the property you're looking to purchase. Same thing if you're looking to sell. Your realtor who's going to sell your house for you will give you a set of comparable sales and say, we think your house is worth about this much based on recent sales of similar properties. Well, commercial real estate is a little bit different because rather than being valuated based on comparable sales in the area, it's based on the income that the property produces. And when we talk about income, we're talking about a very specific income called the net operating income, which is simply our income minus our expenses. And so if you think of apartments as a business, because they are, you have income that comes into the business, which is the rents collected every single month. We then will have expenses that we have to pay for. Think about management fees, utilities, taxes, insurance, etc. And after we've paid for all those expenses, the resulting net income or net operating income is what determines the value of our asset. And so commercial real estate valuations are based on that NOI, that net operating income, divided by what's called a capitalization or cap rate. And a cap rate is simply a percentage that relates the income the property produces to the value that it's worth. And so, why this is important, if you look at my little example down here in the box, say we have a property that produces $75,000 of income. If the cap rate for that particular apartment complex in that area was 8.3%, just giving an example, the value of that property would be worth 900,000. But if we were able to somehow increase that net operating income from 75,000 up $15,000 to $90,000, and then we divide by that same cap rate, our property is now worth $1.08 million. And this is the power of investing in commercial real estate. Because if the example that we were looking at here was a residential property or a single family property, our increase of income would not make a difference in the value of the property. But because it's a commercial property, we can increase the value by increasing the net operating income. And we commonly refer to this as forcing appreciation. And so, forced appreciation is one of the secrets, if you will, of commercial real estate investing that can make it so lucrative. The ability to buy a property that has the potential to increase the NOI through either income increase and or expense reduction, thereby increasing the net operating income and therefore the value of the property. So the good news is this is the most complicated slide of the night. So it's all downhill from here. But the key takeaway is that if you can increase the net income of the property, you can increase the value of the property. So I mentioned that on one of our large apartment projects, we have two different sets of partners. We have what are commonly referred to as general partners, and then we have limited partners. And so, as mentioned, the general partners are more of the sweat equity portion of the project, and the limited partners are the capital portion. And so, if you look at some of the roles and responsibilities that break down between the two, you'll notice, general partners would be the ones who find the deal, look for investors for the deal, manage the deal after closing, and ultimately help to exit the deal in a favorable manner. Limited partners, of course, would invest capital, and then they would be passive during the management of the deal. Some of the key distinctions between general partners and limited partners include the time commitment. Being a general partner, I would contend, is an extremely active role, full time or a lot of time that must be devoted to successfully be a general partner. And then being a limited partner is a mostly passive endeavor. And the reason I say mostly is because it's still important as a limited partner to do your due diligence up front on investments that you're making, and then to stay on top of the investor reports that come out and make sure that you understand what's going on within your project. But aside from those two things, it's a passive investment. You'll notice the risk level as a general partner is much higher. You have capital that you have to front for the project before it closes that's at risk. You have to be a guarantor on the loan. And of course, you have a reputation at stake as a general partner. As a limited partner, limited refers to, first of all, the level of responsibility and risk. It's much lower than that of a general partner. The only risk is the capital invested, but then the control of the project is also limited. As a limited partner, you don't control the day-to-day of the multifamily investment, and that's another key distinction between general partners and limited partners. And then finally, the returns. How do each of these two classes make money? Well, both of them benefit from what's called a waterfall distribution, which we'll explain a little bit later in the presentation, but essentially it's just a profit share of earnings on the property. And then general partners tend to make additional funds from fees on the management and acquisition of the property. And limited partners can oftentimes make additional returns through what's called a preferred return. So who else is involved within a team on an apartment syndication deal? So first of all, there will be other general partners, right? So usually these deals are not done by one single general partner like myself, but rather we usually have a team that comes together in order to get these deals done. You can think of it a bit like a group project in school that's very big, right? If you did like some kind of senior capstone project in school, you know that those types of projects are so big that it's not really feasible for one person to do them. And it's kind of the same way with an apartment complex. Each general partner probably has their own skill sets and things that they're particularly good at. and they bring that to the table of the partnership in order to work together as a team and see the best outcome on the deal possible. Some other team members that are worth mentioning would be the lender. This is the person who provides the debt for the property. A very important one, the property manager, which is a third party, usually management company who runs the day-to-day work on the property. And so when we go in and we purchase these properties, we formulate a business plan of what we want to charge for rents and what improvements we want to make on the property. But it's our property manager who actually runs the day-to-day of the apartment business in terms of collecting rents, leasing, handling maintenance, etc. And then finally, there's a lot of other smaller roles within the apartment syndication role, including CPA, a tax consultant, insurance agent, etc. So, who invests in these kinds of deals? Who are our investors at Apogee? Well, I would say that we have a very wide range of investors. We've been fortunate to help people who are, brand new to real estate and looking to invest for the first time, all the way to several family offices who are very sophisticated and make large investments in our apartment projects. However, I think there's just kind of a few key distinctions that would unite all the investors within our deal. So, first of all, we look for investors who are financially able. That means you have sufficient funds that can be completely tied up for an extended period of time. And what I mean by this is that there are many advantages to investing in real estate. However, one of the negatives to real estate is that it is an illiquid investment. So if you go and put a $50,000 investment in the stock market and tomorrow decide that you need that money back for XYZ reason, you simply go to your brokerage account and pull the money out. Well, in real estate, it's not that simple to get funds out of a deal. And in fact, in these type of projects, it's pretty much impossible until the point where we go and sell the deal in the future. And so it's important that you only invest sufficient funds that can be completely tied up for the time period of the business plan, and that you don't invest funds that should something go wrong, it would have a major financial impact to yourself or your family. One thing I would highlight here is that funds for real estate investments like this can come not only from cash, but also from 401k or IRA accounts. And so there's very specific self-directed IRA accounts that actually allow you to invest retirement funds into the types of apartment projects that we do, if that's something that you would be interested in. The second key distinction of all our investors is educated and sophisticated. And what I mean by this is that when I first started out as an investor, investing in my 401k in the stock market, I really didn't have a strong understanding of what I was investing in or what my investing strategy was. Well, we want our investors to generally understand what it is they're investing in, why they're investing in, and what the risks and merits are of that investment. And that's one of the reasons that I do webinars like this, so that you can take time to learn a little bit about these investments. Now, obviously, this doesn't mean you have to know every single number or all the ins and outs or know every detail or take a test. But what it does mean is you should generally understand the investment, why you're interested in it, what the risks of that investment are, and what the potential rewards are as well. And then finally, flexible, right? Every real estate investment is different, every business plan is different, and ultimately every deal plays out differently. And so flexibility is a really key thing that we look for in investors within our projects. So let's talk a little bit about risk and reward, okay? So one of the common ways that risk versus reward is measured in the world of investing is something called the Sharpe ratio. And if you look at this graph here, you see a plot of annualized return versus annualized risk. Obviously, we would like to have a higher return and we would like to have a lower risk. And you'll notice on this that commercial real estate, although not risk-free, is lower on the risk spectrum compared to many other asset classes that you see, but also has the potential to offer very high returns. And that's one of the reasons that we like it. You have the ability to buy a hard asset, a physical piece of property that doesn't just go up in value in one day to the next, but rather has a lot more stability than, say, a very volatile stock market investment. It's a business, meaning it has income, expenses, and ultimately produces income ongoing, which provides stability. And then it also comes along with tax benefits that we will talk about here shortly. All these things combined are just some of the reasons why we like investing in real estate so much. The ability to have a hard asset that's a business, produces cash flow, where we can force appreciation or force the value upward on the property and receive tax benefits are all multiple ways that we make money through commercial real estate investing. On the right, you'll see a plot of $50,000 that's invested over a period of 20 years at different return levels. And so oftentimes, people will say, well, I'm happy with an 8% return or a 10% return in the S&P 500 or 12% return, etc. And the purpose of this plot is really twofold. First of all, to demonstrate that the amount of return that you achieve on average over time is really important in the ultimate amount that your money grows. So in this plot, we have a $50,000 investment, which over 20 years at an 8% return grows to about $200,000. But all the way up here at a 16% return grows to almost $1 million in the same time frame. And this is why getting a healthy return on your investment at the lowest risk possible is so important if you want to build wealth over time. And it's one of the reasons that real estate has been so successful at helping people build wealth. So, before we jump to this particular slide, I want to bring up one more chart. And we're talking a little bit about why we like real estate investing. Let me take just 2 or 3 minutes to say, why do we want to invest in real estate right now? Like, why would we invest today versus 5 years ago versus 10 years from now? Well, I'm going to keep this brief because there's probably people in the audience who are already aware of this. But commercial real estate and apartments in particular has actually gone from a peak pricing level back in 2021 to now a bottom or near bottom of market pricing level that we see today. And so if you look here, one of the things that drives valuations on real estate is the interest rates. And so we will go out and secure a loan that's usually around 70 to 75% the value of the property that we're purchasing. And the interest rate on that loan and the ability to borrow money largely drives the valuation and price of real estate over time. If you went back to one of the earlier slides, you'll remember that we had a cap rate. And the interest rate, oftentimes, although not directly correlated, will influence that cap rate, which in turn can influence the valuation of the property. And so you'll see here that from 2020 to around 2022, the Fed funds rate, which although it doesn't directly control interest rates, it does indirectly influence them, was near zero as we went through COVID and the aftermath of COVID. However, starting in spring of 22, the Fed increased rates at a historically unprecedented rapid level, and we peaked out around middle of 2023, and then they began some relief of the Fed funds rate in fall of 24 and then again in fall of 25. And then the corresponding 10-year treasury, which does directly influence the borrowing rates that we have in multifamily, as you can see, was very low back in 2021 and has been around 4 to 5% now for the last few years. And what this has done is it has forced pricing downward on multifamily assets to where we are now at, in my opinion, a near bottom of the market point in the real estate cycle. Obviously, making this a very prime opportunity to go and buy commercial apartment complexes. And so the chart on the left here you see is cap rates. And without making you go back and do all the math, the lower the cap rate, the higher the value of the property. And so if you just say, hey, I've got, $100 of NOI, if you divide that by a 5 cap, you'll notice that's a much larger value than if you were to divide that by a 10 cap. And that's the reason why we have seen valuations go down so much. As this number, this cap rate number, has risen over the past few years, commercial real estate prices have actually lowered and pushed down. However, the forecast in the near future is actually for some minor compression of these cap rates as we expect to eventually see interest rate relief and rent growth coming into play within many of the markets that we're in. Finally, another thing that bodes very well for apartment investing is the home mortgage to rent ratio. You can see the last few years, the gap between what it costs to rent versus what it costs to take on a new mortgage is at historically high levels. And so many families who prior to 3 years ago could have afforded to go purchase a house and take on a mortgage can now no longer afford to do so because that number has gone up so much. And for us as investors, that provides a good opportunity because it means more demand for the apartments that we're leasing. So let's talk a little bit more about how multifamily investments work. So, to begin with, the general partners will go on a search for a multifamily property. And while this might seem rather simple, I can tell you that we've had times where it has taken us the better part of a year to find a single multifamily deal that fits our criteria, we believe is within our risk tolerance, our buy box, and the profile of, what we're looking for an investment opportunity. We then submit offers or LOIs on properties that we like. And then if one of those LOIs is accepted, we will go under contract to purchase the property. During that purchase or that contract phase, we will go out and source a loan from a lender to purchase the property, as well as capital from our investors, who you will remember are called limited partners. We will also be performing due diligence, which is basically a fancy way of saying a physical and financial inspection of the property to ensure that it matches what we think it does, right? So when we go and analyze properties, we have certain assumptions for how much rent we can get, how much CapEx improvements we need to make the property better. What has the property been doing historically? Due diligence is all about verifying those assumptions. We then work closely with an attorney and legal team in order to close the deal and coordinate with a property management team that will take over the property at closing and execute on our business plan. Now, the mistake that many new investors make is they think that once you've purchased the property, raised the money, found the deal, that most of the work is over. I would argue that you're actually just at the start line because once you close the deal, you then have to asset the manage the deal or execute the business plan for the next 3 to 7 years, depending on the length of the business plan. And this can actually be one of the hardest parts of multifamily investing is operating the assets after closing. It requires a very detailed project management background, asset management skills, and construction management to go in and make those physical improvements or CapEx improvements to the property. Now, after we've purchased the property, manage it for a number of years, we'll have an NOI target, an income target that we're trying to achieve. And once we've hit that and feel that we can hit the projections that we've, set out for investors, we will go to sell that project and then return the original capital invested to investors plus the profit per the waterfall splits that I mentioned. So, some of you here may be a little bit less interested in this, but for those of you who are, there's several ways or, types of debt, if you will, that we will put on our real estate projects. One in the middle here, agency debt, is kind of the gold standard of multifamily investing. This is government-backed Fannie Freddie loans that have low fixed rate interest debt over long hold times. And so this is typically what we like to target if possible on our projects. However, some projects do not qualify for agency debt because they're lower occupancy. They need more, physical improvements to qualify for agency. And so those projects, we will go for a bridge loan or sometimes a bank or what's called CMBS, commercial mortgage-backed securities loan in order to execute on these deals. Um, Apogee Capital, we have actually used every single one of these types of loan products on across our portfolio at one point or another. So we're very experienced in all of them. So if you're a new investor and you're looking at a potential deal to invest in, there's a few metrics that you're going to want to know when it comes to returns. The first one is called cash on cash return. Say, for example, that you invest $100,000 in a multifamily deal, and that deal on a given year is projected to return $7,000 of cash distributions. So, as I already mentioned, apartments a business, right? We have income, we have expenses, and what's left over as profits we distribute to investors. And so, if your pro rata share of that profit came out to $7,000, that would be a 7% cash on cash return. This is really important for investors who are looking for ongoing cash flow in their investments that pay them quarterly, if that's one of the more important things that you're interested in. A return metric that you're probably already familiar with is the average annual return, or AAR. This would be a return metric that you would see used with like a stock market investment, right? You get a average of say 10% over 5 years for a total of 50% return on investment. That would be a 10% average annual return. IRR is probably the most complicated return metric to understand if you're not familiar with it, but it's essentially average annual return, except that it accounts for the time value of money of when the funds are returned to you as an investor. So if you had a deal that had higher cash flow and lower profit at sell, and you compared that to a deal that had lower cash flow but higher profit at sell with both overall returns being equal, the first investment with more cash flow would have a higher IRR because you're getting more of the money sooner returned to you as opposed to later. And then finally, one that I think is maybe the most important for investors to understand is equity multiple. This is simply the total return on your investment across the life of the investment. So, once again, if you put, say, $100,000 in investment and in 6 years you made another $100,000, that would be a 2x equity multiple, meaning you doubled your money during that whole time. So, if you're a limited partner or a passive investor on a deal, how do you get paid? Well, there's really three main ways. One is through a preferred return. This is typically around 6 to 8% and is basically what we would call a waterfall structure, which is just a fancy way of saying the splits between limited partners and general partners, where you as a limited partner would get 100% of the returns up to a certain return threshold. Once again, this return threshold is usually 6 to 8%. So if you had a deal, for example, that had a 6% preferred return, and across the life of the whole deal, it only produced 6% return, the limited partners would get 100% of the returns from that deal. And that's why preferred returns are often really valued by limited partners because it ensures that they're paid first from the profits of that property. The second thing, which should not be confused with the first, is cash flow distributions. We at Apogee do quarterly distributions on our projects. And we think this is particularly important because cash flow is obviously what supports the deal ongoing and it gives investors confidence that the deal is doing well throughout the whole time of the property. Now, it is possible to have a preferred return that is higher than the cash flow projection. So you could have a preferred return of, say, 7%, but a cash flow projection of 5%. And what would happen in this case typically is that this preferred return would simply accrue over the whole time of the property. And then at the time of sell, the limited partners would recapture any unpaid preferred return before a profit split is given between the general and limited partners. And speaking of that profit split, once you're above that preferred return, as suggested in the third box, it would be split per the waterfall structure, typically around 70-30, with 70% going to limited partners, 30% going to the general partnership team for their efforts. So, how do general partners get paid on deals? So, first of all, there's usually a handful of fees that are within a syndication, and it's really important that you, as a passive investor, look at these fees. Some people have very high fees or multiple fees. Just kind of going through these and explaining, what we at Apogee do versus market norm. Typically, we charge about a 2 to 3% acquisition fee of the purchase price. Essentially, what this is in the world of commercial real estate, we as investors represent ourselves. So we don't have an agent who represents us like what you would have with residential real estate. We go out, work with the seller's broker, find deals ourselves, and get them to closing ourselves. And so the acquisition fee is compensation for the risk and effort of acquiring said project. We then typically will charge an asset management fee of around 2% of the gross income on the property ongoing. And this is for executing the business plan on the property, managing the property manager who runs the day-to-day on the property, etc. Some sponsors will also charge a refinance or disposition fee, and sometimes other fees such as like a construction fee. We try to really keep our fees lower with Apogee, and instead, if the deal supports it, simply make profit from the split at the time of sale. And that would be what's referred to here as the promote. This is simply the waterfall split that we mentioned in the previous slide, that 70-30 split between GPs and LPs. So, not only can you receive returns in the form of money on a real estate investment, you can also receive very lucrative tax benefits. And so, if you watch the news, you may hear a lot of people talk about, real estate investors paying little to no taxes. This is what they're talking about. And I won't go into too much detail here, other than to say that many real estate investors pay very little in taxes. Obviously, depends on your specific tax filing situation, the types of investments you have, but there are enormous passive write-offs that you receive in real estate investing that help you to offset other passive income or gains that you have. So think income from real estate investments, from stock investments, etc., that you are able to write off and thereby pay less taxes. So, kind of wrapping up, getting towards the tail end of our presentation here, how does the legal structure work on a apartment syndication deal? So, we structure these within LLCs, limited liability companies. And the purpose of this is not only to form a partnership, but also to protect investors. Essentially, what happens is that if something goes wrong with the deal, the risk and the liability, hence the name of the entity, is contained within the LLC. And so that means if a tenant sues the property and somehow takes the whole property over, you as an investor only have the funds within the LLC or within the investment at risk and nothing more. We usually will have one of these for ownership of the property and then one for management of the property. Another important thing to understand for real estate investing is whether you are an accredited versus a non-accredited investor. So, an accredited investor, very simply, is someone or a household that has a net worth greater than $1 million, not including equity in their primary residence. Alternatively, you can also be an accredited investor if you have had an income for the past 3 years greater than 200K for individuals or 300 for married couples. And then finally, if you're a licensed individual, think licensed broker dealer on the stock market. This is important because some investment groups only take accredited investors and some allow non-accredited investors. We at Apogee currently allow both accredited and non-accredited investors, although we typically have a cap of the number of non-accredited investors that we're allowed to take on a given deal. And you might ask, why is this important or why does this matter? And what it comes down to in essence is the filing, the exemption that we do with the SEC, Securities Exchange Commission. Essentially, if we will file our exemption under 506B, we can have up to 35 non-accredited investors, but we're not allowed to advertise, and all investors must have a relationship with the sponsor. So if you're friends with me on social media, you'll notice that like I post quite a lot on our social media, but I rarely post about a deal that we're actively raising for. This is why, because the deals that we're doing are typically exempt through 506B, and therefore we can take accredited, non-accredited investors, but we're not allowed to advertise publicly. And then finally, if you do a 506C exemption, you can have advertising, but can only take accredited investors. So it's important to understand when you're looking at a deal, are you accredited investor? And if it's a 506C, understanding what the implications are for you, whether you're accredited or non-accredited. When you're reviewing a offering for a syndication deal as a passive investor, there are a few documents you want to take a look at. One of them is the PPM or private placement memorandum. This defines all the risks within the investment, so very important to read. The operating agreement, this is the partnership agreement between you and the general partners on the deal. Subscription agreement, which is simply your subscription or investment within the deal. And then finally, the investor deck, which is basically a PowerPoint, kind of like this, that describes all the ins and outs of the investment, the expected business plan, the analysis, the assumptions, and the projections for you as an investor. So, if you're interested in investing, what are some things to look for in a sponsor on a syndication project? The first thing I'd recommend is track record and transparency. Find someone who you trust, who you believe has high integrity, that will do the best possible on your investment. Obviously, like all investments, real estate has inherent risk. Things can go wrong, but you want to work with a sponsor who has good work ethic and who has the integrity and transparency to tell you both the good and bad of the investment ongoing. Second thing is communication style. Do you like the frequency and the type of communication that they provide on the investment? And then finally, skin in the game. Are the investors investing in the deal themselves? And so I can tell you, we at Apogee always invest back into our deals, meaning we have shares on both the general partnership and the limited partnership side. That's something we do in every deal. But it's an important question to ask so that you know the sponsors, the general partners, have buy-in into the deal that they're investing in. And then finally, the quality of the deal itself. Do the assumptions make sense on the underwriting, which is simply the analysis? So, is the analysis conservative for the business plan? Is the market good that the deal's located in? Are the fundamentals strong? And then, is there clarity on what the exit plan is for eventually getting the funds back to you as an investor? So, in conclusion, I want to highlight that a couple pros and cons of being a passive investor. Once again, the pro is you're completely passive after investing. You have no liability beyond the funds investing, and you can get better risk-adjusted returns on average than many other investment opportunities. The negatives to being a passive investor is, of course, risk that you can lose returns or lose funds in the deal, like any investment. You have no control on the investment, and you would have lower returns as opposed to a general partner on the deal. So, in wrapping up, I'm going to actually just skip this slide and talk about a couple different opportunities or resources if this presentation has been of interest. So, I suspect in this audience, there's really three types of people. One, you could be listening to this and be like, hey, this is cool. It's interesting. I don't think it's really for me right now. And of course, that's great. Really appreciate you listening in. Second, you could be listening to this and saying, hey, I'm interested in being a passive investor. Like, I don't have the time, the experience, or the desire to go out and buy real estate on my own, but I would love to invest alongside a group like Apogee. If that's you, feel free to reach out to us. I'm going to be putting a Calendly link in the chat here in just a few minutes so that you can book a call with me if you'd like to discuss more about passive investing in our future deals. And then finally, there could be someone on the call who you want to be an active investor, a general partner. And so you're someone that you're motivated to take the time, learn about this investment class, go out, find your own deals, etc. We now at Apogee are offering what we call our multifamily advisory program. And this is simply like a one-on-one advisory or consulting for individuals who are wanting to get started in multifamily investing. And we really have two different branches of this. One is, as I mentioned, a specific program for people who want to learn the basics of investing. They want to go out and do a deal on their own. And the objective of this program is to help you get your first deal done. But then there's also a mastermind group for those of you who maybe have already done one or two deals as general partners, and you're looking to network with really high caliber real estate investors like myself, like some of the partners that I work with, and want to have access to a room where you can meet and ask questions. So, whether you're interested in being a passive investor or an active investor, would love to have a conversation with you. And in fact, I'm going to pop a Calendly invite or a link in the chat so that you can book time if that's something of interest to you. And with that, we will go ahead and conclude the presentation portion of this. Can I go ahead and answer any questions? As a reminder, you can pop them in the chat, or not in the chat, excuse me, in the Q&A box. It may be on the More tab at the bottom of your Zoom. Yeah, so we have one question here that says, this is interesting. Is there more education or information on how I can protect my downside as a passive investor or do my own due diligence? Yeah, so there's a couple of things. One, I would encourage anyone that just wants to learn more for free, go to our website. We have a ton of free resources. A few of them are mentioned here. We have an ebook that's interesting. I've been a guest on dozens and dozens of podcasts. We now have our own podcast. And then finally, if you want to spend a little bit of money and do a full course on basically dissecting deals as a limited partner and being an expert at looking at them, evaluating them, we actually offer a master class, which is a few-hour course that Paula and I developed that's like all the red flags and gotchas that you can think of as a passive investor. Of course, I'm also happy to always jump on calls as a general partner and answer questions on our deals as well. Thanks for tuning into the Apogee Wealth Podcast. I certainly hope you found something valuable in this episode that you can take with you and apply to your own investing journey. If you found the show valuable, you can subscribe so you don't miss further episodes. And if you'd like to learn more about ourselves or our company, you can visit our website, www.apogeemfc.com. We have a ton of educational resources that I'm sure you'll find quite valuable. Until next time, happy investing.